All right, so today we're diving into a topic, kind of well, it's whispered about a lot on Wall Street,
Mm-hmm.
stock-based compensation. We're
Right?
talking about stock options, grants, that whole thing,
Yeah.
all those incentives.
Yeah.
And you've given us some interesting research and articles on it, so we're going to, break it all down.
Yeah. Hopefully this helps you understand some of the implications of it all, especially as an investor.
Exactly.
Yeah.
Mhm.
Now, Henry Singleton, the mastermind over at Teledyne, right?
Right.
He used the company's stock like a pro,
Hmm.
acquiring businesses when Teledyne's stock was, through the roof.
Right.
But it's different when companies use that same stock to pay their employees.
It is.
That's what makes this whole deep dive interesting.
Mm.
Yeah, that's right. Singleton was out there buying real assets, real companies, real value.
Right.
But, when you're talking about using stock to compensate employees, it's kind of like, well, they're locking in a discount on those shares.
Right. Yeah, it potentially impacts, my piece of the pie as an investor.
Yeah, it's exactly right. You're diluting, you're adding in more shares,
Mm-hmm.
which can, decrease the value of the shares already out there.
Right.
Now, this wasn't always the norm.
Mm.
SBC kind of has its roots in the startup world, right?
Right.
Companies that were really strapped for cash,
Mm-hmm.
they needed to attract talent, so they'd offer a piece of the pie, of the potential upside.
Right. It makes sense. You got these early stage companies, big dreams, no money.
Exactly. They're like, hey, come join us. Maybe we'll both be rich.
Exactly.
But, these days you've got companies rolling in cash. Apple, Google,
Mm-hmm.
they're using tons of SBC.
Right.
And that kind of begs the question, is it really about talent?
So let's talk about that, the talent war argument, right?
Right.
Companies often say they need SBC to attract top talent.
Right. Got to compete in this cutthroat job market.
Right.
But, you look at a company like Google,
Mm-hmm.
legendary perks.
All right.
A mission that, top people want to get behind.
Hmm.
And more cash than they know what to do with.
Right.
They don't exactly struggle to get good people.
No, they don't. And in their 2017 annual report,
Mm.
they even said SBC was key to attracting talent.
Mm-hmm.
But, money talks, right?
Mm.
And their cash flow tells a different story. 2023 alone, $307 billion in revenue.
Yeah.
$307 billion.
Yeah.
They could afford to pay competitive cash salaries if they wanted to.
Absolutely, yeah. And that's what's so fascinating, right? If these companies are doing so well, why rely on SBC so much? Maybe it's actually stifling competition.
Right.
Stopping talented people from joining smaller companies, startups, where they
Yeah.
could actually have more impact.
It's almost like they're saying, we can only afford the best, but we're going to pay you in monopoly money.
Right.
And it's like, but you've got a vault full of gold right there.
Yeah.
It doesn't make sense.
Yeah, it doesn't add up.
It doesn't add up. Okay, so another argument you hear a lot.
Yeah.
SBC helps companies save cash and grow faster.
Mm-hmm.
This whole idea of deferred compensation, right?
Mhm.
They say it frees up capital for investments and things.
Mm-hmm.
But explain why that might not be as straightforward as it seems.
So, in reality, SBC is a form of equity financing.
Okay.
And often, it's the most expensive kind.
Okay, wait, hold on. How is giving stock to employees more expensive than, say, a loan?
Okay, so think about it this way. When a company takes on debt, they pay a fixed interest rate.
Right.
But with SBC, the cost is variable, and it can get really big over time. Plus, the real cost isn't always clear when they hand out those stock options. It's like signing a blank check.
So even if it doesn't show up as an immediate expense, SBC could become a huge problem down the road.
Exactly.
Okay.
And here's the kicker. Companies often use this expensive form of financing even when they have cheaper options available.
You're saying companies swimming in cash are still choosing the SBC route.
Yeah, they are. Let's look at Apple, for instance.
Okay.
They keep increasing their SBC, but they have a ton of cash just sitting around.
Mm-hmm.
Back in 2006, their SBC was tiny, just $163 million, less than 1% of their revenue.
That's surprisingly small, actually,
Right.
for Apple.
Fast forward to 2023.
Mm-hmm.
That number explodes to almost $11 billion.
Yeah.
Almost 3% of their total revenue. Meanwhile, their operating cash flow is $28.6 billion, cash balance of $166 billion in 2023.
Wow.
Even with their debt, their net cash was still a massive $57 billion. To put that in perspective, their net cash has actually been cut in half since 2018.
Wow.
Largely due to, you guessed it, share buybacks.
Okay, so hold on. Their SBC is going up, they're overflowing with cash, and they're buying back their own stock.
Yep.
That doesn't really make
It
sense.
doesn't, does it? It's like they're playing a game of financial Tetris, but the pieces just aren't fitting right.
Speaking of Buffett, didn't he have some thoughts on this whole thing?
He did. He's not a fan. He and others have criticized companies for essentially issuing stock to employees at a discount and then buying back that same stock on the open market at a possibly inflated price.
Right, right. It does make you wonder about their motives.
Yeah.
But how does all of this impact the market as a whole? You mentioned it's not just an Apple or Google issue, right?
No, this isn't just about them. This is distorting the entire market. And to really understand why, we have to talk about dilution and buybacks.
Okay.
Right? So when a company issues new shares, it's basically like cutting the ownership pie into smaller slices.
Right.
Each share represents a smaller piece of the company, and that's dilution.
Right.
Now, diluting shareholders isn't always bad, but it's how companies are trying to fix it that's a little fishy.
You mean share buybacks. Those have been all over the news.
Exactly. Companies use their cash to buy back their own stock, which reduces the number of shares out there.
Right.
And the idea is that this should boost the value of the remaining shares.
So it's like they're trying to put the pie back together after cutting it up with SBC.
Yeah, you could say that. But here's the thing. Companies often buy back those shares at the market price, which could be way higher than what they initially gave them out for with the stock options.
So they're buying high after selling low. That doesn't sound like a good plan.
It's usually not. And remember all that buyback activity we talked about?
Yeah.
Deutsche Bank research shows that from 2009 to 2019, corporate buybacks in the U.S. were the biggest force in the market, bigger than demand from regular investors. In 2019 alone, companies buying back their own stock outstripped supply by $4 trillion.
$4 trillion. That's hard to even imagine. But it sounds like these buybacks, which are being fueled by SBC, are really messing with how the market values these companies.
Exactly. It really challenges the efficient market hypothesis.
Which is, just to remind me.
The idea that stock prices reflect all the information that's out there.
Right, of course.
But this constant demand from corporations buying back shares, it creates an artificial demand.
Yeah.
And that can inflate prices regardless of how well the company's actually doing or what's going on in the economy as a whole.
So the market isn't as efficient as we once thought.
It definitely makes you wonder. And this problem is made even worse by the rise of passive investing.
Passive investing, right?
You see, passive funds, they track specific market indexes, like the S&P 500.
Right.
They don't actually pick and choose stocks based on research. They just follow the index.
So when companies buy back their shares, their stock price goes up, and then they become a bigger part of the index.
Right.
So those passive funds have to buy more of that stock to keep up with the index, which drives demand even higher.
Exactly. It's a feedback loop. And some people think this is creating a bubble, an SBC bubble, where those inflated prices are going to have to come back down eventually.
And then investors are left holding the bag.
Right.
So even beyond the market implications, isn't there a fundamental problem with this idea that SBC aligns executives' goals with those of shareholders?
That's a really important point. The idea that giving executives a stake in the company through stock options makes them think like owners and do what's best for all shareholders, that's often presented as, the gold standard. But in reality, it's just not that simple.
So the ideal is the company does well, the executives do well, everybody wins. Where does it go wrong?
Well, it often comes down to different time horizons. Shareholders, especially long-term investors, are in it for the long haul.
Right?
But executives are often under pressure to deliver results quickly.
Of course.
And they have those vesting schedules for their stock options.
Right.
So this creates a situation where executives might prioritize short-term gains to make their stock options more valuable now, even if it's not the best decision for the long-term health of the company.
It's like choosing a quick sugar rush over a healthy meal.
Exactly. And don't forget, many executives see those stock options as just another form of compensation. It's not necessarily that they feel like owners. They might be more likely to cash out when those options vest instead of holding on to the stock for the long term like a true owner might.
Right.
It creates this gap between their incentives and what's best for the long-term shareholders.
So if just giving out stock options doesn't really align everyone's goals, what's the alternative? How do you get executives to think like long-term owners?
Yeah, that's a big question. There are companies doing things differently, though,
Yeah.
and it might surprise you, like Berkshire Hathaway.
Right, with Warren Buffett.
Yeah, Buffett's always been a big believer in just paying his executives in cash.
Interesting.
No stock options, no fancy grants, just cash.
So how does he make sure his team is motivated to do well if they're not getting stock-based compensation?
He aligns their interests with the shareholders very directly. At Berkshire, executives have to invest a big chunk of their own money into the company's stock.
Wow, so they're buying shares on the open market just like anyone else.
Exactly. Their own success depends on the company's success. No safety net.
It's real skin in the game.
Exactly. And Berkshire isn't the only one. Constellation Software, a really successful Canadian company, they do the same thing. Executives have to have a lot of their own money invested in the company's stock.
It really makes you think if you're asking executives to put their money where their mouth is, it separates the people who really believe in the company's future from the ones who are just there for a quick buck.
Exactly. It sends a strong message to shareholders. And it can help you find the right people to begin with.
Right.
If the leadership team is willing to bet their own money on the company, that says a lot.
Reminds me of a story. This CEO was choosing between two people for a CFO position, and they were both great on paper.
Okay.
So he asked each one, would you be willing to invest a significant amount of your own money in the company?
Oh, I like that. What happened?
Well, one candidate was all for it, said he believed in the company and was ready to put his money in. The other guy hesitated and eventually said no, said he preferred to diversify. And the CEO said that one question told him more about those candidates than any interview or resume ever could.
Brilliant. Asking them to put skin in the game doesn't just align their incentives, it helps you identify the right talent right away.
Right, and it avoids those situations where executives might be so focused on short-term stock prices and when their options vest that they lose sight of the bigger picture. But shifting gears a bit, what about employee morale? Isn't getting stock options seen as a good thing? Like a bonus?
It seems that way, but it can actually be stressful, especially for employees who aren't used to how unpredictable the stock market can be.
I can see that. How does that play out in a real-world situation?
Take Palantir. They went public back in 2020,
Okay.
and their stock price was a roller coaster. Went way up, then plummeted back down. For their employees who had a lot of their compensation tied to the stock, that kind of volatility was a nightmare.
Watching your potential earnings disappear overnight, that's got to be tough.
It creates so much anxiety. Employees start to feel like their hard work doesn't even matter because everything depends on the stock market. It can lead to lower morale, less productivity, people quitting.
And the taxes. If the stock price goes way up before those options vest, you're getting taxed on gains you haven't even seen yet.
Right. It just adds another layer of complexity. That's why I think the Buffett and Singleton approach makes a lot of sense. Keep it simple, pay your employees fairly in cash, and let them decide how they want to invest their own money.
More transparent for everyone. But we can't ignore the accounting tricks some companies use to downplay the cost of SBC, like leaving it out of non-GAAP earnings. Why does that matter to investors?
So, GAAP, generally accepted accounting principles, those are the rules for how companies report their finances. Non-GAAP earnings are basically a company's way of saying, look over here, not over there, when it comes to certain expenses.
Convenient.
Very. And one of those conveniently excluded expenses is often stock-based compensation. They're trying to make their profits look better by ignoring a real cost.
So it's a rosier picture than what's really happening.
Exactly. Warren Buffett, Terry Smith, these are big names, and they've both criticized this practice as misleading. Terry Smith said, as long as accrual accounting is the standard, the non-cash argument simply does not pass muster.
It's like saying, yeah, we gave away millions of dollars worth of stock, but it doesn't count as an expense because we didn't physically hand over any cash.
It just doesn't add up. And it makes it harder for investors to really understand what's going on with the company's finances.
Well, we've covered a lot in this deep dive into stock-based compensation, from the potential downsides and how it affects the market, to why it's so important to really understand a company's compensation practices. So for our listeners, what's the key takeaway here?
The key is to be informed. Don't just assume that stock-based compensation is always a good thing or that it's harmless. Look closely at how a company uses it, how they account for it, and whether it truly aligns with the long-term interests of shareholders. You know, your interests.
Maybe prioritize companies that stick to cash compensation and require their executives to invest in the company themselves.
Exactly. Look for companies where the leaders are owners right alongside you, not just waiting for a payday.
Great advice. As always, everyone, do your own research, think for yourself, and invest wisely.
Couldn't have said it better myself.